Welcome to Centaur Financial Services Podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Welcome everyone to another Centaur Financial Services podcast. None of us can believe how fast this year is going, and we're now time. We couldn't believe it this morning. We're saying we're doing an end of financial year podcast this morning. It's just been a crazy 6 months. So we've obviously got Nick with us and Anthony. G'day. And this is just going to be a quick hitter. We've just got to stay on top of this. Every year we know the rules change, so we're just going to fly by today. On our website there's also going to be information if you want more detail, as well as always talk to us if you really want to, some personalised advice. So Nick, lead us off. We've got what does it mean this year? What are the changes coming? But more importantly, what are the strategies clients need to consider before June 30?
Great. So off the bat, everything really as you approach end of financial year comes down to contributions, because it's almost the last bite of the apple for the financial year. So considering, firstly, when we talk contributions, there are the two types. Well, there are a few more, but what I'll be talking about here is firstly concessional contributions. So that's an annual cap of $30,000. We do need to consider that what goes into that concessional contribution bucket is employer contributions, salary sacrifice arrangements. So whatever space is left, there is the availability to contribute cash sitting in your bank account into the superannuation environment, and then you can actually claim a contribution, a deduction for that contribution, I should say, back on for your assessable income. Very beneficial. We can also look at utilising catch-up concessional contributions. So this is a really good one where we might have income that's a bit higher this financial year, or we've sold an investment, so we've got a high capital gain. So the purpose of looking at this one is really we want to reduce quite a significant amount, if available, of assessable income via a tax deduction. What this is, if your balance is under $500,000, we can look back at the 5 previous financial years of unused cap space. So if I say right now you've only used up 10,000 of the total 30,000 annual cap, we can look at this year's as well as those previous years and put that all in the current financial year and claim it all in that current financial year. So a really valuable consideration there. Then we move to the non-concessional contributions. So a bit different. We don't claim tax deductions on this, but this is an annual cap where we're just putting money into super dollar for dollar, right? So the annual cap for that is $120,000. Or alternatively, we can look at utilising what we call the bring forward arrangements, utilising 3 financial years at once, so $360,000. If we do have quite a large lump sum, we want to get that money into super because of the benefits of having that in a tax-free environment. We might even consider doing $120,000 previous to 30 June and then $360,000 in the following financial year, getting just shy of $500,000 into super over a month period.
If there's a couple, you can get a lot of money into
Exactly
super.
right.
What else can they do in terms of contributions?
There is the downsizer, which would be the other one I would consider. Again, that's very event driven. You would have had to sell a property that you've lived in for longer than 10 years or longer and make that contribution within 90 days of settlement. So not so much a end of financial year strategy, but a contribution strategy nonetheless.
Yes. Okay. Yeah. So we're trying to keep this quick.
Yeah. Sorry.
So tax deductions. So obviously we need to work with your accountants. You need to work with your accountants, especially in regards to work-related tax deductions. Obviously, working from home, the occupation-related expenses that come in along during the year, just have them all sort of written down and ready to go for your accountant. Probably secondly, just further to Nick's comments around super contributions, the other one that a lot of people tend to forget is the spouse contribution, whereby if you've got a spouse, a gainfully employed, earning under $40,000, you can make up to a $3,000 contribution and you can get a tax offset, not a tax deduction, a tax offset of $540, which can be quite worthwhile. The other one is just having ready for your accountant for your investment properties, your investment strategies, anything creating an income with the expenses associated with it. So interest costs for the purpose of that, your advice fees, financial advice fees, accounting fees, and importantly, your property costs. And probably just the last one on that I'll mention in regards to potentially a sale. A lot of people do forget that in the event of a sale of a property, in particular an investment property, it's not the time of settlement, it's the time of contract of sale. That's when the time of sale is, and that's when you'll then be eligible for either a capital gain or loss event.
So if you've entered into a contract to sell your house now, and settlement's July 15, the capital gain is going to be in this year.
Correct.
So if you want to make contributions to super or something to offset that,
Yep.
you've got to do it this financial year.
Absolutely.
And I think also if you've got other assets that have gone down in value, if you could get a capital loss,
Yep.
that would then offset the capital gain.
Yep.
So that's really good things to think about there. Something that's been talked about a lot recently is transfer balance cap and indexation. Do you want to quickly touch on that for our listeners?
Yeah, so 1st of July we get indexation of the transfer balance cap, 1.9 million going up to 2 million. What is the transfer balance cap, you may be asking? It's effectively how much money in that superannuation environment you can transfer to pension phase, which is that tax-free phase. So with that indexation on the horizon, if we are considering moving to pension phase and we do have super balances up around that 2 million mark, it might be effectively
Wait until July 1.
you get an extra 100,000 there of tax-free money.
So, and I'll quickly just go forward a little bit. And this if you've heard of this Div 296 coming out, so what the government's kind of saying is you can have the first 2 mil into pension, which is going to be nil tax. Whatever's above that is going to be taxed at 15% because it's got to stay in accumulation effectively. And then what it is above 3 million is going to wear an additional 15% tax.
Yeah.
So if you can kind of see the way the government, the ATO is trying to work it, first 2 mil tax free, next mil 15 mil after that, or whatever we've got after that, 30. So keep that in mind as well. Or again, always talk to us. Superannuation guarantee, changes there.
Yep. Super wasn't in the crosshairs too much in this budget, which is good, but who knows what's to come. But importantly, from July, what's going to happen with Super Guarantee will go from 11.5% to 12%. So for
Good for business owners.
Business owners, there's a little bit of an impost there, but great for us contributing to superannuation. Probably the second one to note is in terms of our contribution cap, so they are staying as they are. So as Nick mentioned before, $30,000 for our concessional contributions each year, and secondly $120,000 for your non-concessional contributions each financial year.
So remember they went up last year, so a lot of people when we talk to them still think it's the 27,500 and 110. So just noting that they are 30 and 120 this year. And you can always go into your MyGov to check your balances and what contributions have gone in. We've got some info sheets on how to do that if ever you want to look on the website. Going into just some housekeeping around anyone with an SMSF, what's the stuff they've got to look at?
Yeah, and it really is just in relation to self-managed super funds. It's just meeting those minimum pension payments if you are a retiree and drawing out of an account-based pension. Each year, the minimum amount you need to draw out of your super account is calculated based on the value 1st July, and that percentage based on your age. So just making sure you meet that minimum. There are pretty big issues if you do not, and a lot of mucking around from the accounting perspective. So that's probably the main one. In terms of strategies that are available there's always, if you've got one member of the spouse in pension phase, the other in accumulation, there are the options of drawing out and recontributing to either even out super balances. There may be some good tax planning. Again, that's going to be case by case basis, so not a strategy I'd be running to do without discussing it with your respected advisors.
Yes. Okay, so wrapping up, I think we've gone over our 5-minute mark. Are we over our 5 minutes? Yes, we are. So recapping, we've talked about super to help with tax deductibility. Remembering that we don't do super just for the tax deduction, we are doing it as a long-term growth compounding engine. But the tax break certainly does help. We know the contributions that we can do. We're aware of downsizer. We've got to make sure really if you're listening to this now and you think, oh, should I do something? get it done now, because if you get to sort of mid-June, it's too late. You can't always trust the product providers to, get it all right. So we've really got to get all the strategies done really end of May, first week of June. For all the clients that have contacted us about the super stuff, thank you very much. We love the proactive planning element. Please keep coming back to us with any feedback or questions or stuff that you want us to talk about. This is all for you. Next episode, we are going to talk retirement income streams and how to turn super into a steady tax-effective income. And we could talk about that one for hours.
Absolutely.
But we won't. All right. Thank you very much, guys.
Thank you, guys.
Thank you, everyone. Bye.